and mortgages. We have Erez is talking here. Erez? I think he's outside. Okay. And Itamar Hassan, SVP at the Pagaya. Itamar? Oh, perfect. So I'm gonna grab. Okay, you start. I'll grab. Okay. Thank you, Tal. Thanks everyone for staying for the lending panel. Here we have Erez with us. Join us. Thank you, dear panelists. So before we start, maybe we'll go with just around the table to introduce ourselves to the audience. Who wants to start? Dani, go ahead.
Morning, Nick Cordoni, I'm the head of operation in partners.
Moving. So, good morning, everybody. Thank you, Mr. for inviting me. My name is Uri Oden, and I'm the co-founder and CEO of USA Mortgages. We're a fintech lender in the United States. We lend to foreign nationals in 18 states in the United States. Real estate plays interesting times. I'm sure later. Thank you.
Hi, my name is Derek. I'm the CEO and founder of Crisco, Credit Risk Community. Founder in 2015, we work in the US, Mexico, Australia, and in the UK. We're doing technology and open accounting and open finance, enabling SMBs to share more information to lenders and potential creditors. And we opened last year as part of our group direct financing, MCA, for student capital, and we provide financing directly to small businesses investors.
Hi, thank you for having me here. It's a pleasure to be here with you. And my name is Itamar. I'm 31 years old. I'm a mathematician with a PhD in physics. I'm the SVP research at Pagaya. We're working on consumer lending, mostly in personal loans and also, but also in point of sale, buy now, pay later, and credit cards. We are working with investors and our partners, which are also in most of the companies in the US, to generate more financial inclusion and opportunities for investors.
Okay, thank you very much, dear panelists, for joining us. Erez, I want to start with you from your experience as an alternative lender. And maybe we'll talk a bit about alternative lending and this space. What is the social impact of alternative lenders, if any? How do you see it?
That's a great question. So sometimes we forget that the actual impact of what we do, and we only feel about the money, technology. Some people like the money, some people like technology. But the fact is that the financial inclusion that we do with FinTech enables a lot more businesses and people to get access to services that sometimes seems to be very basic. I think Mexico we are in Mexico. In Mexico, 75% of the business don't have access to capital from the banks or any other institution. Another 20% get access just from small groups of financing, like 30 financing, maybe mostly traditional financing in Mexico, and only 5% get access to banks. We were able to provide impact by not just building all the business. They're able to provide financing, to provide solutions to business. If it's a digital bank, if it's digital lending, I can give you two examples that we have on our website, success stories. Liliana, she's the woman, the late 30s, she wanted to branch out from one coffee shop to two coffee shops in the same city. Very successful woman, and she didn't have access to any funding from anywhere. We were able to provide her $5,000. That is $5,000, and her life and family life changed this year very much more successful. Just one story out of many that's the five impact. Very important.
So definitely, so underbanked and bank, they have access to capital, to loans, and that's great. And maybe we will address the mortgage industry. How do you see the mortgage industry turning in light of COVID-19? What was the impact and what emerges out of it?
What is COVID-19?
We forgot.
Yeah, so basically, I think most of us forgot it. But the mortgage industry didn't forget it. It's, it was, one lesson for us, for the mortgage industry, and I'm speaking from a point of view of a lender in the United States. It was, first of all, a lesson it made all of us humble. Okay, we understood that we don't know a lot. Okay, it made a lot of question marks. As a lender, we mitigate our risk from two major parameters. One is the personal behavior of the borrower, and the other is real estate. And Corona changed both of them, was game changing for both of them. So for us, it was crazy. Okay, people, the real estate, people left the city. People stopped working from the office and went home. And it was an interesting time. Our AI models went crazy. We came back to doing things with pencil and old school. And mostly, I think it was a rehearsal, a good rehearsal for what we see now when the rates are hiking and everything is changing again. So life is changed and we're addressing that.
I guess the population adapts to COVID and also the tech companies adapts to COVID and it changes everything. And this is just in the mortgage space. Itamar, maybe you'll give us your highlights on the impact of COVID in the general lending space. Borrowers and lenders, what was the main impact there? Yeah, so obviously there has been a major impact. I think not only because of COVID in itself, but because of the market reaction to it that echoed and generated a ripple effect. So I separate the story to, let's say, three parts. We started with COVID, abruptly showing in China and then the rest of the world, causing a lot of tension, a lot of stress, a lot of concerns. Causing some unemployment, some people losing their jobs, and not being able to pay their loans. And it drove a very rapid tightness from investors, at least in the consumer lending market, I guess also in other markets. This stress caused a ripple effect that manifests itself in two ways. One way is that the governments and the policymakers in general, the central banks across the world, particularly in the US, and tried to resolve the issues of concerns by flooding the market with a lot of liquidity. On the other end, the government also generated a lot of stimulus for the borrowers. So we have seen a short period of time where the market was short by short, maybe 6 months, maybe the market was still showing a lot of concern from the borrower behavioral perspective, but the borrowers actually performed very well because of the stimulus. And then when this very good performance, low losses, high returns showed up, and the market was flooded with liquidity because of the government and the central bank's initiatives, many investors tried to get into the market. Generated a very highly competitive environment with a lot of liquidity, causing rates to drop, while consumer behavior still was good because of the stimulus. At some point, stimulus stopped, but liquidity was still very high, and investors were still very eager to participate in the market, and this caused a very sharp, again, like over a period of about 3 months, I think, we have experienced throughout the market, across all the consumer lenders, I think, a very sharp drop in returns, projected returns, very high losses, causing again a reaction by investors that pulled out of the market. At the same time, we've seen inflation coming and rising, probably again due to the same and liquidity flood that we have experienced, causing the central banks to generate more tightening. And now we are kind of back to square one from a financial perspective, because liquidity is very low. And we see, I can say from a guy's perspective, but this is probably a broader group. We see performance and losses reducing because of not stimulus for borrowers, but because of very small competition and much less than we used to have in the past, and especially during the stimulus period. Now the question is, what will be the investor reaction to that? Because liquidity is still very low, they might see performance being very good, and flood us with liquidity, even though the central banks still not flood with liquidity. So this is kind of a wisdom of the past, but who knows what we know in the future.
Yeah, thanks for that, Itamar. And we also saw different, I think thanks to COVID, different lending possibilities for consumer lending, point of sale lending, BNPL, buy now, pay later, and it's really on the rise. I think it got a good push and it was easier to borrow eventually. And let's go and speak about a bit about AI and how this component involved with lending. We see generative AI on the rise. We see it touches and influence all industries, cybersecurity, embedded finance, and of course also payments and lending. How do you see AI getting into this space? Will it make risk assessment easier or it opens the gaps?
By now, as far as we know, there is no massive use for AI in the banks for lending. They are starting using models. There are a lot of papers regarding AI and lending. And once they use it, first they use it as a marketing credit. And I must say that all the noise is really annoying.
If you get into the door, you get shot.
Maybe lock the door and nobody will get out. We have AI for marketing credit, and there are some new models for credit scoring, and using not only financial data, but also personal data from for the social media, for example. We believe that, and for the first steps, we see that the banks are not using the models for doing the credit scoring, but for monitoring models, the linear models, the regular models. We believe in AI, and we believe that it can improve credit scoring, it can improve marketing, make it more accurate, and maybe improve financial inclusion. But there are some concerns regarding privacy and discrimination, and we are concerned for it. And there is a interagency task force from the Bank of Israel, Ministry of Finance, the Competition Authority, the Israeli Security Authority, the Israeli Market Capital Authority. I hope I didn't forget anyone. And we are trying to think whether there is a need for a regulation and when to put the regulation in order not to stop innovation and in order to make innovation more fairness. And we think it's very important in order to prevent yes.
In order not to be like Italy, preventing AI. Anything else to add on top of this? Okay, happy to. So I think there's a new movement today in the market. One that is an eager wish by every financial institution, including banks, to explore how can I use AI, how can I use it safely, and how can I embed it into my processes. And at the same time, we have the regulators, I would say universities, the scholars are just publishing papers after papers, how risky it is and how to control. Now, right now, there's no collusion because it's still too young, but I think there's going to be some point in the near future that we're going to see, like Italy, starting to ban stuff. I saw a paper from a Tel Aviv University that was published that was, for me as an entrepreneur, was very scary. It's all about what you shouldn't do, not about what you can do. And I think that it's important to remember that AI brings prosperity, brings more options, and brings technology, and a lot of value to all of us. And I'm connecting to COVID-19 that we talked about in the previous question. We are still in COVID-19. It's been 4 years ago, 2020, but we are in the after effect of COVID-19, the high inflation, the status of the economy that we see today, direct context of the COVID-19 period. And AI is one of the tools that can actually bring us back to track. bring innovation and bring us as a global market back to a growth and a good. So I do believe, and I think that's very important to be positive about it, to nurture it when they deploy it. We get a lot of questions from almost every financial institution which we have conducted. How can we use it? What does it look like? What do I do with it? How can I make it safe? And we try to answer it.
Thanks for that.
ChatGPT to answer.
ChatGPT can answer everything. Obviously, anything to add on this?
Basically, I totally agree with Anita about the regulation which is necessary in the state. But I think there is a thing that is already happening, and that's the efficiency role of AI in the lending industry. Lending is paperwork, and it's not efficient. There's a lot of people handling a load. And when you have generative AI, which does part of the process, and I'm not talking about the risk assessment, still that wait, not down the road. But for now, doing most of the process with AI enablement is already happening, and that's the good news for the industry. Yeah.
Definitely. I must say that we are doing AI risk assessment every day in Mexico State. So
Together with that,
we still have someone called during the UN, so there's a man that's still with COVID or a woman. But we are using the risk assessment and we do a lot of ways to the score. If it's strictly negative score, if there's negative score, then we don't apply it.
So that's an interesting point. And, maybe we'll touch the difference of credit scoring and risk assessment and the way it's done by fintechs, such as Risco, say mortgages, or comparing the way done by financial institutions. Itamar, maybe you can enlighten us on the difference.
So the risk assessment by AI on Pagaya, the risk assessment is done completely automatically with the machine learning model of AI. So I'm done with your point, but when compared to banks and traditional institutions, I think you need to understand the different drivers that drives the business. Now, put the risk assessment aside for the moment. Bank, as opposed to fintech, is controlling two things that are very important in the lending business. One is controlling the funding, because banks usually take deposits of their general customers and turn those deposits into loans to other investors. So they are kind of in control of the volume. Obviously, there can be an issue like run of the banks, people logging out of a specific bank, and that particular case, they don't have control over funding, but usually this is not the case. So they control the funding as opposed to fintechs, which usually rely on investors of some sort. And therefore, they can allow themselves to have some hiccups and errors from time to time, banks, as opposed to fintechs, which really rely on their reputations to generate more funding. Second, banks control the flow of applicants much better, because eventually, again, the applicants, the board are the bank's customers mostly. Again, with some exceptions, but this is the most likely case. While with fintechs, usually a fintech is trying to connect many different partners, getting as many lead sources as possible, and those lead sources are companies by themselves. They have their own policies, they change their policies from time to time, and this is causing, again, more changes, requiring a much better risk assessment. Much better risk assessment, much better diversification. Third point, which is, again, connecting to the other 2 points, I think pretty much sets the tone on whether risk assessment for banks is very important or some other operational heavy lifting is more important. For banks, is the choice of most of the banks due to their limited funding capacity and many different potential customers to focus on the more safe part of the population. When you look at the ladder of risk, when there is a shake in the economy, the ones that are in the bottom of the ladder, very safe and not very high risk, those usually don't move a lot. And if there is some non-optimal risk assessment, you might lose 10 basis points, 20 basis points, 30 basis points. It's not the end of the world. Why if you're working, trying to generate more financial inclusion, like the fintechs are using, are trying to generate, and you're up the ladder in terms of risk, and a small shake will cause you to be exposed to the bad risk assessment you've done. Combining all of that, if you have relatively solid funding and relatively low potential from sophisticated risk assessment to improve like 10, 20 basis points of return compared to the other losses you have, which are more operational, marketing wise, etc. It's much better, I think, for banks to invest the money on the operational heavy tasks. There are also other issues with risk assessment by banks using machine learning has to do with regulation. But this is time, I think.
Thank you very much. And Erez, maybe we'll go back to you with the global aspects of lending. You operate in different markets with your company in Latin America, in the US market, in Israel, in Europe. How do you see the differences between innovation and adoption in terms of lending in between these different markets?
That's a great question. Thank you. So I think the markets are hugely different. We sometimes we feel like we can run everything in the globe and we are global connected. And I've been working in Australia, UK, and the US prior to COVID at the same time. So 3 different countries, it's 3 different continents. It's been challenging. But COVID, I think that's brought a lot of the difference between the different markets. Even for the basic, I don't know how many of you know, but in Latin America, Mexico leads the process, but also in Chile, Peru, Colombia, there is complete digital invoicing in the market. So every invoice issued by a business is digital and submitted to the government in real time. It means that even for the grocery, what we are doing this morning, the government already knows. It doesn't happen in the US, it doesn't happen in Australia or Israel. In the US, you actually don't report anything to the government, only the tax returns once a year. So this by itself creates 2 different markets from data point of view, completely different. Now, in the US, if you talk about startup, technology, innovation, that will accept you very nicely and will be eager to hear from buy. In Mexico, what are you talking about? Talking to me about business, how much money you make, how many customers do you have, where is the bricks, what's going on, what do you sell, and what do you buy? But I think those changes are dramatically and created the influence of the key decision maker in the organization. So if I'm talking to a bank in the US, the type of question they will ask is how the AI works, how can I connect, how can I embed the technology into my place. In Mexico will be, okay, how do I make money out of it? How my customers see it, how the customer knows I'm not doing it fraud, how I might not be fraud by the AI. So those are very different questions that you need to answer in different ways.
Thanks, Erez. And Uri, maybe we'll hear about your experience in the US market. How do you see that we can simplify processes for the end borrower?
So again, technology is the lead for simplifying processes. So we saw that before when we started doing things digital and regulation supported it, and we started we act as a lender, as an international lender, and once when we gave a loan, we needed to notarize the things. We went with the customer to notarize, and then we uploaded it online. Let's say we give a customer sitting in Berlin a loan in the United States. So we need to have somebody in Berlin and somebody in the United States. Today we have notarize.com and we do everything online at a fraction of the cost and the time consuming. So technology makes life simpler and makes life better in many aspects. And I think we just began mentioning AI and generative AI. We will have a lot of good wins in our back.
Thanks for that, Uri. And Ilanit, maybe we'll go back to you. How do you see the different innovative lending solutions reshape the market, the ecosystem as a whole?
So we speak about our steps. First, open banking that was mentioned this morning. We are, I think we are the first country to regulate open banking for credit for loans data. We mandate the banks to give the access to data about loans customers. And once you have better data about the customer, you have a better models for credit scoring and to check to assess the risk. And also we have the credit bureau in the Bank of Israel that every creditor, everyone wants to give credit and there's a license. Can reach the credit bureau and have data about the customer. And I believe that this is the first layer that about the customer is the first layer for improving credit and scoring and improving and to make it more fairness and precise to choose to lend and what is the price to make it fair. So our point of view is to improve the data.
Thanks for that, and definitely helps the open banking revolution, definitely helps the financial institutions in this space also to integrate different lending solutions and lending innovations. Itamar, what do you see, how do you see the biggest challenges of these financial institutions when integrating lending technology?
Yeah, so I think it's a very good question. We are struggling with that on a daily basis, trying to grow into cooperating with the bigger financial institutions. Learning from successes and failures, I think you need to recognize first what is the actual value proposition of those innovations for the different participators. So I'll give you just one example. We are cooperating with an auto lender, a very big auto lender in the US, providing them the standard product that Pagaya is providing, financial inclusions, more borrowers being accepted, improved, at better rates, etc. But when we look at in retrospective, why did they actually engage with us? Then it's very different from why other partners of us have engaged with us. The regular fintech partner that has engaged with us, what he provides to the market is also financial inclusion of some sort, etc. But the way the business model of those partners is usually to take fees from someone, usually the investor, sometimes the borrower itself, and they're making their profit through financial inclusion, generating fees and profit. However, when you are talking about traditional banks, etc., usually they don't make money off of fees as much. I mean, when it comes to lending, they make fees for other kind of products. When it comes to lending, usually they don't make their money off of fees, but they actually make the money off the actual coupon that they are charging for the loan. Is they have deposits. They want to leverage the deposits into coupons, interest rate, etc. So when you are suggesting financial inclusion and improving more people, where does the funds for those loans come from? From some other investors. So it doesn't really support the business model of the traditional bank. In the case of this auto bank, what turned out to be the actual incentive for them is that through the financial inclusion, including more people, they will be able to convince the dealers that are usually sending the applicants towards them. They will convince them to send more applicants towards them, improving their core business. So they will be exposed to better population, and they will see better economic outcome for the regular applicants that we're doing. So we're kind of doing them a favor in the sense of increasing their reputation in the eyes of the dealer. So this is a very non-trivial kind of value proposition, but only in retrospect, I think I at least understand. And so this is one challenge. You need to understand the value proposition, and for different traditional players, it's different. The second obvious challenge that we have with the traditional lenders and banks is the regulation that is, first of all, much more heavy on those. And second, I think there are concerns due to the last few years events that there will be even more scrutiny, and we need to be able to convince them. if we want to cooperate with them, and if they want to do it by themselves, again, they need to convince themselves that the trade-off is worth them. They're going to benefit enough that it's worth the cost, the risk, the regulatory risk if they're going to face.
Thank you very much, Itamar. And we could speak about lending innovations forever, really, but we really need to wrap it up. But before we do that, maybe a piece of advice, Uri, and there are the entrepreneurs on stage, from you to the entrepreneurs in the audience. How would you improve the penetration rate basically in financial institutions? What can work better when you try to work with financial institutions as a tech company?
I think it's all about relationship. That's the key to everything in life, and especially working with FI, the financial institution. We're lucky backed by few financial institutions, and I think it's all based on relationship, which is a long time relationship. I just came back from Japan. Relationship is when I say long time, sometimes they say they want to meet you in 2-3 years from now, just to see how things are done before they even start to say hello. So it's all about relationship, and I think relationship is a starting point. I think what Itamar mentioned about having a clear value proposition is the basic when you come into the financial institution, because there's a lot of people in these organizations, and you need to find the right business, so the business owner for your business, and then have a clear value proposition of working with all of them. Eventually, the number one piece of advice working with them is creating trust, because these guys have a lot of info coming into them, and they need to trust the person who's working with them. And one last thing, you have to understand what they need. Okay, sometimes I see a lot of people telling me, "Hey, I want to work with these guys," and there must be an understanding of a regulation of a business ecosystem, what they need. Because if you don't really understand them, you won't be able to create a good relationship with them.
Yeah, fully agree. Aaron, anything to talk on this?
Actually, I agree with you with everything you said. With all the AI and everything is based on relationship. Everything is based on knowing the market that you're selling into, knowing the competition, knowing what's happening, knowing what they need and what they're afraid of. And I think that the best example I gave is when you go to buy something, you're not the special, you're not the person who knows what to buy. You want to buy a chair, you want to buy a chair, you go to a chair manufacturer, you don't know how to make a chair, but you know you need a chair. But you assume the chair manufacturer knows everything about chairs. Maybe it's an example, but still the one I had now. When you come into a bank or you come to a financial institution, you should be the professional. You should know what you're selling. You should know what they need. You should know why they should choose you and not other services, and why they shouldn't do the same as they've done in the past 10, 20, 100 years. To make this value proposition very clear and transparent, just basic. Go make sure that if you don't sell to anyone, then you all understand what you're saying, why they should buy it from you, and what value do they bring.
Thank you very much. I want to thank you all in the leads, Uri, and Itamar for joining me. It was definitely insightful. Thank you very much.
Thank you.